Good morning, everybody, here and online. Thank you for joining us today. My name's Lauren. I've been working with Benchmark for the last, I want to say seven years. So if you've attended one of these events before, you probably could respect what I'm going to talk to you about today. And so as the presentation suggests, I'm going to talk to you guys today about how you can look at generating similar type of returns you might expect from an equities portfolio over a long period of time using debt instruments. And when I was doing these presentations a couple of years ago, that was a pretty difficult slog because a lot of floating rate debt instruments are linked to cash or BBSW, which is generally linked to cash. So when cash is zero, debt looks pretty boring and equities look pretty exciting. It's nice that, the tide has turned slightly. So just a quick disclaimer, I don't know you or your personal circumstances, so everything we talk about today is general, and if you'd like advice, please speak to your advisors. Quick intro to Thinktank. We are a non-bank property lender. We lend money to people who are self-employed or who want to purchase through an entity like an SMSF, a company, a trust, for commercial or residential property, all small ticket. We don't do construction and development. We started in 2006. We saw there was an opportunity in the market where the banks weren't really servicing their SME customers who wanted to purchase commercial assets, and they're still not fantastic at doing that. And then over the years, as APRA changed certain capital requirements around holding assets on your own balance sheet, and just as the banking cycle has changed in the last 20 years, we've been able to expand our business into offering residential lending as well, and our borrower base is much greater than just SMEs. So anyone that doesn't quite fit into the bank's cookie cutter model, the non-banks are usually your next point of call. As a non-bank lender, we raise our funding through bonds, and we issue bonds to the debt capital markets, and we raise those funds predominantly from institutional investors, ironically the banks, and we also have a couple of private offerings. So I just wanted to share with you how we originate our debt and also where we raise it from. Similarly to a bank, we operate on a net interest margin model, so many of you would be familiar with that style or that particular phrase if you've invested in banks in the past. Just a quick snapshot of kind of who we are and how we've grown. When we started in 2006, it was predominantly commercial lending, and then from about 2018 onwards, we really ramped up into residential lending, and now the split of the portfolio is more residential than commercial. We do small ticket commercial, so that pie is a bit smaller, whereas the residential space, there's a lot more opportunity for growth, and that's been a big driver of our growth over the years. So quick question, anyone invested in bonds in the past? Yes? Yep, great. So we're familiar with the bond. What is a bond? It is a debt instrument, which means we, as a lender, we are from our investors. If we do not pay our monthly interest payments, similarly, if you don't pay your mortgage, the person or the institution that owns that debt will come knocking on your door saying, thank you very much, I would like my interest payments, otherwise I will take that security back from you. As the investor in a bond, if Thinktank doesn't make its monthly repayments on the scheduled date, you as the investors get to vote on what to do with the underlying collateral. So from a issuer's perspective, there's a lot of added risk on our side if we can't meet our debt obligations. From the investor's perspective, hopefully you have a lot more comfort around, one, the security, but two, being a debt instrument, you have a lot more recourse as opposed to other asset classes where you might not as such. As a mortgage lender, our bonds are secured by a pool of assets, which are the mortgages, and the underlying security there is the small ticket commercial and residential property that we originate. So that's sort of how the flow works there. So how do we achieve equity-like returns by investing in debt instruments? And what I mean by equity-like returns is if you look at the equities market over the last sort of 20, 30 years, you might be looking at a range, an index, sorry. You might be looking at a return between your sort of 9 to 12s if you've invested in the index over a long period of time. Obviously, part of that is income, part of that is capital. I'm purely talking about the income component here, but because interest rates have risen and are probably going to stay at this level, maybe not this particular level for that much longer, although it still could be another couple of months, 6 to 12 months, they're going to stay above 1 to 2% for quite a while. So by investing in floating rate instruments, you're able to generate quite a juicy income return, which obviously for trustees and for SMSFs I imagine would be a big part of your portfolio. So these just might be opportunities that you haven't thought of before. So as I mentioned, the bonds are secured by a pool of assets. So let's dive deep into what those assets look like. Our entire portfolio, we crossed 6 billion recently, and this is just a snapshot to show you how well diversified our pool is. And I will very happily share these slides with you and presentations with you, so please don't feel that you need to take photos or that they're going to disappear, because I'll share that all with you later. So what I wanted to highlight here is, from an individual investor's perspective, it's quite expensive to go and purchase individual assets to create a diversified portfolio. And that's regardless of the asset class, really. That's why we have ETFs, that's why we have indexes, that's why we have bond funds, that's why we have other funds where you can access a diversified pool of assets. So yeah, as I mentioned, we're a small ticket lender, so you can see a lot of these metrics here. We write lots and lots and lots of little loans. So as investors in the bonds, and this is institutional and private investors, you're exposed to a very large pool of loans, which means if one loan goes bad, it's not too big of an issue. If lots and lots of loans go bad, that's more where you're at risk. And that's only going to happen if we see a systemic economic slowdown, collapse type scenario. And you can see there's quite a lot of equity in the portfolio, so 34% worth of borrower's equity. So we would need to see quite a significant drop in asset prices for that to occur. So the income trust, this is a trust. We issue income bonds, so the income bonds are secured by the loans in the income trust. As I mentioned at the start, we get a lot of our funding from our institutional investors, who are the banks. They have a certain eligibility criteria of loans they can and can't accept in their funding facilities. Every couple of times a year, and we settled a deal yesterday, we package up our debt and sell it off into the debt capital markets in what's called a securitization. So we do residential mortgage-backed and commercial mortgage-backed securitizations. What we found in the market was our institutional securitization investors had a much wider appetite than our domestic bank funders. So we needed to find a balance sheet fund where we could house loans that we saw as good credit, good margins, and could be refinanced, could be securitized. And that's what the income trust does. So the income trust is just a smaller version of our entire portfolio, and the income trust is what's available to private investors at the moment. And again, you can see it's a relatively well-diversified portfolio there, with over 50% in industrial. Being a commercial lender, we do have commercial exposure. And again, I'm talking small ticket commercial exposure. I'm not talking large office towers, large medical centres, large shopping centres, none of that. It's all small ticket. And the majority, 50% of our commercial exposure is in industrial, which is one of the few commercial assets that had a different trajectory than other commercial assets over the last few years. So many of you will be familiar with how a first mortgage structure works. The bank owns the debt, the borrower owns the equity. In this case, you are the bank. Investors are the bank. You are in that, I'm going to call it orange, but I think that's probably not orange, but I'm going to call it an orangey red colour, which means in order for there to be a scenario where we can't pay our investors, the only way that's going to happen is if we're not getting the income from our borrowers. And that's only going to happen if we see high level of unemployment, high level of arrears, we're going to see asset prices drop. So from an investor's perspective, you're protected by 30% worth of borrower's equity. Now, I'm not suggesting that the residential market is going to not have slowdowns. Eliza Owen was speaking at our offices yesterday, and at no point in her presentation did she mention a 30% decline, and I'm not sure that I want to be in Australia if that was the case. But just so that you're aware, that's what your security is. That's the borrower's equity that sits underneath. So you're able to earn a pretty juicy income return by being the bank. And what is that return? So the income bonds are 3.6 fixed over bank bill swap rate 30 days. So it is a floating rate note, which means as interest rates have risen, your return is rising because your risk is going up because the borrowers are paying more. And the reverse will happen as rates start to fall. The default risk will go down, your return will go down. So by investing in floating rate debt that is linked to this benchmark, your risk and return is very much like a seesaw in that respect. Thinktank is currently only open to wholesale and sophisticated investors. We have you can start with a 10 grand minimum investment and build up. So we don't have large minimum investment sizes. It's just meeting that high net wealth wholesale investor test. Because our borrowers pay monthly, you get paid monthly. So there's that monthly income stream that is generated from the mortgages, and those funds are secured by the underlying security properties. And because you're buying a bond, you have an extra level of security there. This is recent, so this week, end of last week, we received our first domestic rating by SQM for our income trust of 3.75 stars, which is the best that you can get as a first rating. And being an illiquid fund, because we're a mortgage fund, our bonds have a fixed term. It's unlikely we'll ever get to 5, so we're pretty happy with 3.75, but I just wanted to share that with you as well. Our term deals, our CMBS and RMBS deals get rated by Standard & Poor's, and the AAAs get rated by Fitch. So we are constantly being rated, but in the institutional market. So this rating is our first step into engaging with the domestic retail self-directed market, but also the wealth management market with much more gusto, which I'm really excited about. So I mentioned the income trust is a relatively small part of our book. So the question is, well, where does the rest of the money come from and how does it work? This diagram here is what's called the debt capital stack. So are we all familiar with a capital stack? So there's debt at the top, there's equity at the bottom. Yep. In the debt capital stack, there are different levels of that debt capital stack. Similar to equities, where you might be buying common equity or preferred equity, or you might buy government bonds, or you might buy hybrids. Maybe not anymore. So the debt capital stack, this is all a first mortgage facility. So if you imagine that this is 500 million worth of loans and it gets split up into different tranches. So Thinktank is able to offer investors a relatively high rate of return in our high yield trust, which sits at the bottom here, because we get 85% of our funding from the banks at a very tight price over cash. Is everyone familiar with the concept of weighted average cost of funds? Yep. Okay, so weighted average cost of funds. If you're getting 85% of your funding costs at 90 basis points over cash, and you're able to pay, so say the mezzanine debt, they might earn 3% over cash. The high yield trust is currently earning 6.5% over cash, and the equity tranche, which Thinktank owns, might take 8% over cash. So you might say to me, well, Lauren, how do we earn 10.8% if your borrowers are paying 8.5%? I'm not great at math, but you're going to run out of money pretty quickly. The reason that we are able to offer a higher return for these subordinated bonds is because we obtain quite a large amount of our capital from the banks at a very tight price, and our weighted average cost of funds sits at about 1.8% less than what we charge our borrowers on average. And that's the net interest margin that I was talking about before. So we are a net interest margin business. So it's all about how do we obtain a large portion of our funding at the tightest price possible from the senior funders, which in this case are domestic and overseas banks. And because we can get that funding quite tight, we're able to offer investors in other areas of the debt capital stack a slightly higher return. Higher return means higher risk. We know this. So what is the risk? Because you're investing in a subordinated bond when you invest in the high yield trust, you are exposed to losses if they occur before the bank is. So essentially all of the capital comes in at the top of the waterfall at the end of every month. We pay the bank first, and then we pay our subordinated bonds, and then we pay the high yield trust, and then we pay Thinktank's capital. And the remaining income that's left over is called the excess spread, and that's Thinktank's income. So the reverse will happen should there be any losses through the portfolio. Losses will go bottom up. So Thinktank's capital is at risk, and then the high yield trust capital, and then the bank's capital. So when you look at these, and these graphs here are the underlying CMBS and underlying RMBS. So the high yield trust isn't exposed to 100% of our portfolio, but it's exposed to 80% of it. So I wanted to share with you the data and the assets that you are exposed to here. So you can see, where are we there? Well, there should be. Maybe it was on my first slide. There was a data point that said weighted average borrower rate that's at about 8.5. So when I say we can offer you 6.5 over cash, that's 10.8 at the moment, but the borrower's paying 8.5. How does that work? Hopefully that explanation there added some comfort around that. And this is our resi portfolio. So all this data is available, and this is really just to highlight how well diversified you are across a range of asset classes, across a range of borrowers, across a range of states. And when we're looking at investing, diversification is key, and we all know trying to do this ourselves, buying individual assets, is quite expensive. So if you're looking for that diversification and you're comfortable with the underlying credit risk and you're comfortable giving up control of owning the assets and picking and choosing, these might be suitable alternatives to have a look at. So there's a couple of things to think about when you're investing in bonds. The first one is, well, what's my risk of default? So what's the chance of things going pear-shaped? And as I mentioned, we are a property lender. So underpinning all of our investments are real income-producing small-ticket properties. So the big risk is that we see high levels of unemployment, high levels of arrears, falling asset prices. That's the risk. The high yield trust, because it invests in our institutional programs, has exposure to slightly better quality of borrower because that's our bank-funded warehouse. And as I mentioned, the income trust funds those loans that just don't quite fit into that bank-funded facility, but can be securitized. They incur a higher rate. There is an added level of risk. So your income trust loans are slightly elevated level of risk than your high yield trust loans. The next thing to think about when investing in bonds is what's my loss given default? So how much am I going to lose if the underlying securities fall apart? Again, we're talking about 34% worth of borrower's equity across small ticket property here. The high yield trust, because it's a structured product and because it sits at the bottom of the capital stack and subordinate to the banks, if there was to be a complete asset price collapse, the high yield trust would lose capital at a quicker rate than the income trust. That's the main difference between the two products. So I just wanted to identify that today because I get a lot of questions about why they're underpinning the same assets, why the return's so vastly different. And this is really the key thing. The risk of default is slightly different in the income trust to the high yield trust, but if the underlying security properties fall apart, your loss given default is much greater, is a much greater risk in the high yield trust. And as a result, those equity note holders get a higher level of return. So I guess rounding back to the point of my presentation today, how can you earn equity-like returns by investing in debt? Hopefully I've answered that question today, but by investing in floating rate debt securities, you're able to earn a return, call it between 7 and 10%, because I don't think the cash rate's going to stay at this level for that much longer, but right now your returns are 7.9 and 10.8. But by investing in floating rate debt, once interest rates start to rise, you're able to generate quite an attractive return by taking debt risk. And that's really important as opposed to taking equity risk. So if any of you are interested in these kind of asset classes, the first thing you want to look at is what is underpinning, what are the assets underneath it, and is that risk something I'm comfortable with? And essentially, what are the borrowers paying? Because that's going to tell you where the risks are there. But this is just a graph to show how the BBSW and how our return has tracked over the last, since we started, the funds were open in 2017, and it's very much driven by the cash rate. And that's very common for floating rate debt. Great. Thank you very much. I will be here all day. If you have any questions, feel free, and thank you very much for your time.